Hey, it's Nathan Watt from Watson and Watt. Another video here for you today. This one's a short one, just a step-by-step guide to tax planning, or tax planning 101. So I'm going to step you through how we actually do a tax plan and what that really means. So there's tax planning and tax minimization, and they get used interchangeably, but they are really two different things. So a plan, obviously, is looking forward and how much tax we're going to pay and when is it due. Minimisation is, well, how can we reduce that tax? Now, sometimes they're done together, sometimes they're done separately, but minimisation for small business, there's only so many things we can do. There's no elaborate structuring overseas and moving royalties and all that sort of stuff. If there is, you shouldn't be watching a how-to video and you should be paying for some advice. For everybody else, it's you need to spend some money to save some taxes. And as I said in the previous video, the truth about tax planning, you can't spend your way out of a tax bill. So this is really looking at a business that we've done what we can for taxes. It is what it is. And we're going to look at, well, how do I know what to budget and when is it due? So this is just a dummy company, a demo company in Xero. And we're just going to step through how we actually go about doing that. So this is for 1 July to 30th of April, so we've got 10 months worth of data there. They've got a profit. As you can see, there's been no income tax expense put in there as an accrual, and that's pretty standard for a small business who manages their own books. If you had a bookkeeper like us, or we did your BASs, we would be putting in a provision for income tax every quarter, but that's there already. So let me just see if I can move my head out of the way. I'll get to that in a second. All right, get out of the way. Okay, so here we go. So the easiest way to do this is export it to Excel or Google Sheets or whatever you want to use in terms of spreadsheeting. So we've got 10 months worth of data. The easiest way to do this is just a simple formula. So if we go full year and we say, well, that one is 10 months. So we divide by 10 and multiply by 12, and that's what it should look like for the full year. Obviously, if we can copy and paste that, and that's pretty easy. And we do that, it's already got the formulas in there because it's smart. And just format that so it doesn't look like crap. And I'll do that one. So it looks like this. There we go. Don't worry about the cents because it's not going to be correct anyway. It's just an approximation. So whether it's 20 cents or $2 or $20, it's just an estimate. So that's easy. If your June and July, your May and June numbers are actually different to the average, so if you always have a really busy May and really busy June, then doing this average isn't going to work out terribly well. It's going to be incorrect. So you need to use some common sense around it, put some brain cells to it and say, well, my May and June is different to the rest of the year, or it's not, either up or down, and make some assumptions on that. So if you were doing that, you would get this number, and then you would just add in, well, my invoicing for May and June is going to be 30 grand each, and therefore that's going to be up, or whatever it is. So right now, using this straight annualization method, we have a profit there of 113,000. This is a company, so it's going to pay tax at 25%. So we just put a little formula in here. You can do this with a calculator if you want, but that times that. You definitely don't need to be an Excel genius to work this sort of stuff out. So on the full year, you're looking at tax of about $28,345. And by the look of this balance sheet, no tax has currently been paid. So when this tax return gets lodged, that amount, or roughly that amount, is going to be payable on the tax return. So when is that? Well, if you haven't got any overdue amounts and using a tax agent and all that sort of stuff, a company's tax return isn't usually due until May the following year. So we're in 2022, in May 2022. This 2022 financial year tax return is not due until May 2023. So that tax won't be payable until May 2023. Even if you lodged it on the 1st of July 2022, that tax, that $28,345, still won't be due for payment until May 2023. So you've got some time to save it up if you haven't already. But obviously, if you haven't already saved it, you need to be saving not only for this year that's gone, it was 10 months that have gone, but you also need to be saving for each month that goes on after this. Otherwise, you'll never get ahead. So once we lodge this tax return, a couple of things are going to happen. One is you're going to pay this tax in the following May. And once you've lodged that tax return, the ATO is then going to say, okay, great, you've got tax payable. We now want you to start paying tax in advance in the PAYG installment system. And that comes out on your BASs each quarter. And the ATO basically say, well, last year you had $28,000 worth of tax to pay. We want you to pay 25% of that each quarter. And that way at the end of the year, you won't have this large catch up. If your taxes aren't looking that good anymore, say next year you don't invoice as much or whatever it is, you can vary that down. There are penalties if you go and vary it to zero, or vary it to more than 15% of what the actual tax is. That way it stops people varying it to zero when that shouldn't be. But if it is actually going to be zero for whatever reason, you can vary it to zero. You just need a valid reason for doing it. So once you lodge this, they're going to start on the PAYG installment system. Now that can cause some big cash flow issues if you don't understand how that's going to work. So let's have a look into this spreadsheet here. So this is just 12 months or 13 months worth of the next year. And what we're going to do is map out when these taxes are due. So we're not going to pay any June 22 installment because we're not yet on the PAYG installment system. So the 2022 income tax return is not going to be due until May 2023, and it was $28,345. And then, so let's assume we don't lodge anything until the latest, which is a fairly common strategy for a lot of people. So let's just try and move me out of the way again. There we go. No other taxes are going to be payable until May 23, and then what's going to happen is on the June 23 BAS, it's going to say, well, you haven't paid any taxes for 2023 yet. We want you to pay the same amount again. So that less the other installments that you've paid would equal your June installment. You haven't paid any other installments, so you need to pay that as well, even though that tax return, the 2023 tax return, is not due until May 2024. We need you to pay that now as an installment towards that tax bill. So you're essentially paying 2 years worth of tax in 2 months, 3 months. But this doesn't just stop here. In the September 2023 BAS, there'll be 1 quarter again, which will be due in November. So you're paying 2.25 years worth of tax in about 4 months. So you need to be really careful about what you're doing here and making sure you're saving for this in a bank account. Now let's have a look at what would happen if you actually did lodge it in the September quarter. Let's say you lodged it in August, this tax return in August. What will happen is they say, okay, great, you owe us 28 grand then, but that's not due until May, but we do want you to start prepaying for the 2023 year. So at its simplest, it's just divided by 4. Some years they gross this up, but not at the moment. So in December, that's not due until February. That's going to be the same amount, and this is going to be the same amount, and this one's actually due in August, but we'll put it in here because I haven't got an extra row column. So your tax payments are going to look like this, which is, if you look at it, exactly the same amount as before. It's just in a different sequence of events. So you're not paying any more tax. It's just the timing of it and how it impacts your cash flow. So this is a tax plan. We worked out what the full year profit was going to look like. We then worked out, well, okay, what tax have we already paid? In this case, it was 0. If you've already paid installments, obviously these numbers change. But then we map it out into a calendar like this and go, okay, this is what our tax payments, income tax payments are going to be. This doesn't include GST, doesn't include PAYG withholding, doesn't include superannuation or anything else. This is just the income tax part of it. So in your cash flow that you should be having, should be running in your business, you can enter in these figures in these months and then know what your drawdowns are going to be for tax purposes. So that's it. Quick video today on the basics of tax planning. This is an actual plan. You can't plan to go to the beach after you're already at the beach, and you can't plan your taxes after the end of the year is already over. You need to do it now before the 30th of June, because if you plan this and go, okay, what can we do about this 28 grand? We've got some extra money. Should we go and buy some equipment? Should we go and buy or invest in the superannuation and put some more into super? What can we do? Is there anything that's worthwhile spending our cash on, or should we just suck it up and pay the tax? So you need to plan this before the end of the year. It's no good going to your accountant after the year's finished and saying, hey, I want to reduce my tax, what can we do? Well, you can't do anything because it is what it is. And yeah, so plan it out, work out your cash flow, start saving these amounts. Going back into your Xero file, you can see the 28 grand over the sales. If you're looking at a budget to say, okay, well, how much of each dollar do I need to put away? You need to be putting away, call it 18% in this example, of every sale, excluding GST. So that's just for income tax. That's not GST, that's not super, that's not anything else. That is just for the income tax. So you need to be putting this away diligently, otherwise that can add up real quick, and you just won't have the cash for it. So you can do this quickly for your business. Just follow these steps and let me know in the comments if you've got any questions.